Hi, well investors, welcome to my channel. Charles Schwab stock has been affected so much by all this situation of the regional banks, particularly in the case of Silicon Valley Bank some weeks ago. In this video, I will find out if the business model of the company is really rock solid, or in other words, if the company is investable or not. And if the company is investable, we will need to find out if the current stock market price of the company right now is attractive or not. So looking into the chart here, we can see here that the stock has declined something like 40% since its peak in January 2022 here. Well, some people are saying that the company really right now is cheap because they are taking into account the price to earnings ratio of 15 times earnings. And I would say that, well, if you take, for example, you take into account that this is a company that was growing at a double-digit growth in revenues in the last 2 years, well, a price to earnings ratio of 15 times earnings could be really attractive. But of course, there are certain things that we need to consider here. The price to earnings ratio is do not take into account the quality of the balance sheet, which is something crucial if we are assessing a financial institution, like in the case of Charles Schwab. Really. So if we are a long-term investor, we need to make sure that the balance sheet of that financial institution will behave or is rock solid and is stable over the years, because right now with all the interest rate hikes of the Federal Reserve, well, certain important assets of these financial institutions could be affected so much. So for me, this is my particular view, of course, the most suitable measure to calculate the intrinsic value of this company or any other financial institution right now is the price over book value of the equity. And in this way, we are incorporating the quality of the balance sheet here. So in this way, for example, if the current stock market price has declined 40%, but if the intrinsic value has declined as well, it means it does not mean necessarily that the stock market price right now is really attractive, because the benchmark, the most important benchmark for any value investor should be only the intrinsic value and not how much the company has declined respect to its peak. Okay, so but in order to put certain context here, I will show you some charts in order to show you what is the current situation in the financial industry, to understand what is happening here with the banks in general. So here we have this chart here that indicates the change in bank deposit from peak here. Look at this, almost 600 billion deposits have left the banks since the Federal Reserve began to raise interest rates here, the biggest outflow on record. So look at this, all that money was taken out from the deposit accounts from the banking system, and they were transferring all those deposits to other more attractive alternatives that take advantage of the higher yields because of the interest rate hikes. Of course, this is something that has happened, for example, in the case of the Silicon Valley Bank, in which, well, most of the withdrawal of deposits were explained because there were other alternatives that were offering higher yields than those yields offered by the deposits. Of course, in the case of the Silicon Valley Bank, there were other problems, like in the case of the fact that most of those deposits were concentrated in the venture capital and startups at their very early stage of growth. So really, and given the fact, of course, that most of these startups had so much difficulties in the year 2022 to raise capital, because of course there were so much restrictions to raise capital in that year, since there were more and more interest rate hikes to control the inflation. So really, they, of course, they have taken out their money to use that money, of course, to finance their expansion plans and so forth. But of course, there were other problems associated to Silicon Valley Bank. In general, this is something that has happened just as a result of the policy of the Federal Reserve of rising interest rates in order to control the inflation rate. And yet, you shouldn't forget, Federal Reserve need to reach that target of 2% of inflation rates here. So I would expect, of course, more interest rate hikes. Probably, if not in this year, but in the next year, there will be more interest rate hikes in order to reach that important target. And then, well, this is just another chart that would help us to understand what's going on here. Look at this, that since the date in which the Federal Reserve started to raise interest rates, of course, there were other alternatives, other financial products that were influenced by these interest rate hikes of the short-term interest rates. Look at this in the case, for example, this spread between money market mutual fund rates and bank deposit rates here. The in average at the beginning of the year 2022, the deposits in general were offering only 0.48% in average, whereas the case of money market mutual fund was offering 4.45%, more aligned with the short-term interest rates managed by the Federal Reserve of 5% here. So this huge difference, of course, help us to explain what has happened with the Silicon Valley Bank here, and of course with other important banks here. And I think, of course, that in the case of Charles Schwab, yes, it is something that has affected as well the deposit of Charles Schwab, but you will discover later that it is a completely different situation in the case of Charles Schwab. It is better positioned here in terms of deposits and in assets, and I will demonstrate to you later here. Now, in order to understand a little bit more about the business model of Charles Schwab, we will need to see the disaggregated revenue or the revenue breakdown here. And look at this, that there are so many different kind of services, different kind of generators of revenues here. Look at this, that the cash and investment segregated, receivable from brokerage clients, available for sales securities, held to maturity securities. Both accounts are important, particularly in the balance sheet, and look at this, that they are important generators of revenues for this company. Later I will explain a little bit how much important these accounts are for the balance sheet, for the quality of the balance sheet of this company here, and how, of course, the interest rate hikes are affecting these two important accounts, these important assets of the company. The yields offered by the company by this available for sale security and held to maturity are really important. And look at the bank loans here, because the company could be considered as a hybrid bank here because it offers it or it manages a loan portfolio. But if you take, for example, this how much this bank loan portfolio generates as revenues, if you compare this 1 billion with the total of 20.7 billion, you will discover that it's something like 5%, only 5% of the total revenues are generated by the loan portfolio. I'm focused on these bank loans because this is a business segment that is truly exposed or truly subject of many regulations, in which, well, a bank really used to put so much allowances, provisions, in order to be protected in the case in which these loans are not paid back by the borrowers. So really, this is important to take into account that this business segment is not so much important within the business model of Charles Schwab. There are other important services that not require so much capital allocation here. For example, well, this is available for sale security. This is all these securities, and of course we have the asset management and administration fees of mutual funds, advice solutions, trading revenue for trading services and commissions, and so forth. So all of these services indicate me that we are talking about an asset light company, because there are fixed costs here associated to all these services, but of course these fixed costs are diluted as more and more people is using the platforms of Charles Schwab, and you will discover that a great part of the explanation why Charles Schwab is an asset-light company that is offering high net margins compared with other regular banks. Now, if we go directly to the metrics of this company here from the year 2012 to the year 2022 here, you will discover here that the growth in revenue has been pretty good, has been really good here. In several years, double-digit growth here. And look at this in the year 2021, 58% here, which of course could be explained by the fact that in that year, in the year 2021, we were at almost zero interest rate. So of course, you need to remember that the Federal Reserve pumped with so much liquidity into the system because of the pandemic, of course, and that, of course, gave the incentives to many people to use the Charles Schwab platforms to to make trading, to invest, or to trade different stocks and so forth. So really, the company was benefited by that currency, by that situation. The company was keep growing in the year 2022 here. In terms of the net margins, look at this. This is aligned to what I've mentioned previously respect to the how much this company is an asset light company really, because well, look at this. We are talking about net margins of more than 20% and more than 30% in some years. So and you usually a regular bank used to have, for example, net margins of something like, I don't know, 15%, 16%, but not more than 20% or more than 30%. And this is because of the business segment of the loan portfolio really is really a small part within the business model of this company. This is something good, of course, because most of the services offered by this company do not require so much capital allocation. So we are talking about an asset-light company. Now, look at this in the return of equity, which has been good here in several years. But look at this, what happened in the year 2020 and 2021 here. There was a decline here, which could be explained by a decline of the net income, which has not happened here. But of course, it is explained, of course, by a huge increase in the equity here, or more than twice here, respect to the year 2019. So if we go directly to the financial statements of the company here, we could see, for example, here the consolidated statements of stockholders' equity here, that in the year 2019, the equity was 21.7 billion here. And in the year 2020, 56 billion, more than twice here. In the year 2021, almost the same, 56 billion. And in the year 2022, it has declined abruptly, 36.6 billion. So what has happened in the year 2020? It is because, well, this acquisition of TD Ameritrade of 21.7 billion here, which has been included as part of the equity because the company has paid with cash and stocks with that acquisition. I think that this acquisition has reinforced the moat of this company here. Okay, but of course, we are hoping that this important investment would have interesting returns for the long term. Anyway, in the year 2021, well, I think that this other comprehensive income is something that has concerned me a little bit. And particularly in the year 2022, the same account, other comprehensive income, has concerned me because there is here a negative 21.5 billion, which is the main factor that explains this decline in the equity in the year 2022. Well, this other comprehensive income, in this, it is included most of the unrealized losses of the fixed income securities in which the company has invested in the last 2 years, really. So, and this is because, of course, the interest rate hikes. It is the same problem that has happened in many banks, including the Silicon Valley Bank and other regional banks here. We need to look at the balance sheet here in order to see how much exposed this company is respect to the fixed income securities with a longer term maturities here. For example, if we go directly to the consolidated balance sheet here, we will see here that the available for sale securities and held to maturity here, both of them, some are more than 300 billion, and they represent something like more than 70% of the total assets here. These accounts include different kind of bonds, short-term bonds, middle-term bonds, and long-term bonds here. So if there are a greater part of those securities are long-term bonds, of course, the company is subject to more sensibility to the interest rate because the interest rate hikes affect the most to the longer term bonds here. Okay? Now, something that is really important to notice that available for sale securities, it is basically means that all these assets that are held by the company could be sold at some point in the future. They will not be held until their respective maturities. In the case of the held to maturity securities, all these bonds that are included in this account will be held until their respective maturities. So you can deduce, of course, that it mattered the most, this available for sale securities in terms of unrealized losses, because in the end, if the company is planning to sell them at some point in the future, these instruments could be sold with losses. Okay, in the case of held to maturity, these instruments will not be sold. So of course we don't care so much about the unrealized losses. Anyway, I would take anyway the unrealized losses of everything here because it reveals, of course, the quality of the balance sheet here and how much sustainable this balance sheet is for the long term. Now, if we want to look into the composition here of these instruments within the available for sale securities and the held to maturity securities here, if we go here in the notes of the annual report, you can see here that, well, if we focus, for example, in those bonds that mature more than 5 years, this is the 5 years through 10 years, this is the after 10 years. So we focus in these two groups here. We can see here that these two groups combined represent 50% of the total available for sale securities here. Okay, and in the case of held to maturity securities, well, though both groups here represent more than 90% of the total held to maturity securities here. So clearly it indicates that the company has a really a great exposure to the long-term bonds. It means basically that the interest rate hikes of the Federal Reserve will affect so much the worth of a great part of the assets of this company. Particularly if we consider that the available for sale securities and the held to maturity securities represent more than 70% of the total assets of the company. This explains why I consider that we should take into account in the intrinsic value the price over book value of the equity, because the book value of the equity is the total assets minus the total liabilities. In this way, we are incorporating the quality of the balance sheet in our calculation of the intrinsic value here. Okay. Now, something important to notice is that look at the yields of each of these groups of bonds here. 2.13% in the case of available for sale securities, and held to maturity securities only 1.74%. If you compare, for example, the short-term interest rate managed by the Federal Reserve of 5%, of course, they are poor yields for those investments. But of course, we need to take into account that there are other services that are compensating these lower yields in the case of Charles Schwab, because yes, these instruments are generators of revenues. But if you remember, the company has a really great net margins, and this is because the company is offering many other services with high margins that could compensate these lower yields in the held to maturity and available for sale securities here. Now, coming back to our metrics here, we can see here that we have these the deposits, which is crucial, and I think that any investor will be concerned of the what would happen with the deposits of any financial institution here. In this case, for example, we can see here that the deposit really has declined, and probably the main factor could have been the interest rate hikes of the Federal Reserve. But of course, we will need to understand something important here. Look at this. This is the breakdown of the bank deposits in the case of Charles Schwab here, and more than 90% of them are deposits swept from brokerage accounts here. Now, if you look at this, how many brokerage accounts are in the case of deposits in Charles Schwab? Look at this, more than 33 million in the year 2022 here, and we have 2.4 million of corporate retirement plans and 1.7 million of banking accounts here. So look at this, that we are talking about deposits that are truly well diversified through millions of different brokerage accounts. This is not the same, for example, like in the case of Silicon Valley Bank, which most of that money, the deposits, I mean, the owners of that money were companies, so they were way lower in terms of number. Okay, and they were of course more focused on just one sector, which was of course the venture capital and the startups. But in this case, we are talking about individuals, people who are using their money not just to put their money in deposit, but also most likely to invest in different financial products in the market. So really, I would say that it is way more difficult to experience the same thing in the case of Charles Schwab, that the situation that has happened, for example, in the case of the Silicon Valley Bank here. So really, we are talking about a completely different situation here. And even with that, because, well, we need to find out why, for example, there has been this kind of decline deposits. And well, this is something that you can find information here in the annual reports in which, well, there were a great part of those decline it because there were transfers of those deposits to, for example, the money market funds because they offer a better yield than deposits here. So, but anyway, I think that given the high net margins that this company has, I think that there's no any problem that this company, Charles Schwab, could rise interest rates in deposits in order to slow down the decline of deposits here. We can put ourselves in the worst case scenario because, well, I think that it's important to notice if really Charles Schwab is able to have enough liquidity to face, for example, a situation in which there could be strong withdrawals of deposits, as in the case of Silicon Valley here. So we could see here, for example, these are the deposits here that we could find in the balance sheet here in the liabilities. And then, well, look at this, that the company has, of course, cash in the year 2022 of 40 billion, available for sale 147 billion, and held to maturity of 173 billion here. If you sum the three of them, you would see here that these three components here are not good enough to cover the deposits here because there is a difference here of 5.5 billion here on difference. But you should remember here that the company has deposits for regulatory purposes of 42.9 billion and receivable brokerage clients of 66.5 billion. Both of them combined are more than 100 billion here, which is good enough to cover any small difference in the liquidity here to cover the entire deposits. Now, we are assuming here that all the 100% of the deposit are not insured as well. So anyway, even if the case, for example, that it is not good enough, the company has the possibility to request credit lines to the Federal Reserve because the Federal Reserve has implemented two different credit lines to support the financial institutions in the United States in order to reestablish, of course, the confidence in the financial industry. Okay, but here, for example, we're assuming that the 100% of the deposits are not insured, but in reality 80% of the total deposits in the case of Charles Schwab are insured. So honestly, we should only care about the 20% remaining. And in this case, for example, we have a lot of liquidity here to cover to comply with all the deposits. Even if we have, for example, 100% of deposit that are not insured, we have, of course, all the assets to cover for this difference here or for any difference because probably, for example, in the following years there could be a decline in the worth of the available for sale security, the held to maturity, because there could be, of course, more interest rate hikes that will affect a great portion of those important assets here. And well, the thing is that the company has enough liquidity to cover the total deposits, even in a scenario in which the deposits are not insured. Now, just focusing in the number of brokerage accounts here, this is really interesting because this number of brokerage accounts has been growing at a healthy pace in the last years. And of course, this helps us to understand why the company is diluting its fixed cost here, and that of course help it to achieve higher net margins than any other regular bank here. And this is because, of course, the company is offering these kind of services that do not require so much capital allocation, like in the case, for example, of the loan portfolio here. So really, with all these assets and with all this distribution among millions of brokerage accounts, it is unlikely that the company could face withdrawals of deposits, like in the case, for example, of the Silicon Valley Bank, in which that bank was entirely exposed to the venture capital, which with lower number of startups here. And here we are talking about millions of individuals here, with their own particular interest, and most likely they want, of course, to have deposits in Charles Schwab to invest in different financial products here. But anyway, we have seen really that even in the worst case scenario in which the company could face a withdrawal of deposits, the company has plenty of cash to please all those claims here. Okay, but now we can see here another important point here, the tangible equity. You know that I wanted to calculate the tangible equity in order to see what was the tangible book value of this company. Look at this. Tangible equity is it mattered the most when the company is facing a process of liquidation of its assets. I mean, we are putting ourselves in the worst of the worst of the worst case scenario, really. So really look at this. If we are just concerned about the process of liquidation, we only care about the tangible assets. So we need to subtract all the intangible assets of the company. Now, just taking the total assets of the company, we are subtracting the goodwill, the intangibles, the total liabilities, and the preferred stock. This is the unrealized losses of the available for sale assets that we have seen in the balance sheet here. And this number, I just got this number from here, 12.2 billion here from the available for sale securities and realized losses here. Okay. Now, this is important because, well, look at this, the tangible book value of minus 6.1 billion, just because of this number here. And you know that a great portion of the available for sale securities and even the held to maturity securities in the case of Charles Schwab are exposed to fixed income securities with a longer term maturities here, which are more sensible to the interest rate hikes because they react even more to drop even more than the bonds with a shorter term maturities here. So really this is important to notice here. And but well, even when there are some analysts who are trying to justify that Charles Schwab is not investable just because of this negative tangible equity, so I fully disagree with this because we are not even in that situation, and I demonstrate to you that the company is able to please to have plenty of liquidity to pay all the deposits that are needed. I mean, okay, even in the worst case scenario here. So, but really, this variable tangible equity helped me to embrace more calculation of the intrinsic value, taking into consideration the quality of the balance sheet of the company and not just the price to earnings ratio. For me, the most important one is the price over book value of equity, just because look at this, how just an account of the balance sheet could influence in the total book, in the tangible book value of this company to be negative here. So for me, this is something that I'm taking into account in my mind in order to incorporate this important variable within the calculation of the intrinsic value, because you know that there could be, of course, more interest rate hikes and the balance sheet of the company, and as a result the equity of the company could be affected in the following in this year or even in the next year, just because that there is a great component and a significant component of long-term bonds within the balance sheet of the company here. Now, another important ratio that is really important in any financial institution is the capital adequacy ratio here. In this case, the tier 1 leverage here. Now, in this case, you can see here that in this capital ratio of Charles Schwab has surpassed its minimum requirement in all these years here. So apparently, there is no any problem here. But of course, we need to take this with a grain of salt, particularly in the case of Charles Schwab here. Look at this. We can see here how this formula is, how this ratio is constructed really. Okay, so really look at this is the bank's equity plus reserve divided by the risk weighted assets here. Now in this case, for example, from in the case of any financial institution, any bank here, in the denominator you will take all the assets of the bank and you will assign a percentage for each of these assets, a higher percentage if the assets is riskier and a lower percentage if the asset is less risky. Okay, so you can conclude, for example, that a company with a lot of assets that are riskier, with so much risk, of course they will be assigned a higher percentage, and that of course will contribute to increase the denominator and reduce the tier 1 capital ratio here. The same thing happens if, well, I mean, as the opposite happens with a company or financial institution that has assets with a lower risk because they will be assigned a lower percentages, and that will contribute to reduce this denominator and increase the tier 1 capital ratio here. Okay, so this is important to understand it. Okay, so really the best case is that when the financial institution is pushing up the tier 1 capital ratio here. Okay, now what happened in the case of Charles Schwab here, that the banks, in the case of the bank's equity, it should be included the unrealized losses of the long-term bonds that are held by the bank in its balance sheet here. And if you notice here, for example, we can see that in the annual report of the company in the page 112 here, you can read that the Charles Schwab was designated as category 3 firm. Okay, so they have the possibility to exclude the all the other comprehensive income from its regulatory capital as permitted by the regulatory capital and liquidity rule beginning in the year 2020 here. Okay, so the company is basically saying that they will not include the unrealized losses of its all those bonds that are in its balance sheet here. So this is important because if we see, for example, here this capital adequacy in the year 2022, when there were so much interest rate hikes, of course these numbers should have been lower than 7.20% here. Okay, of course there's no problem here in all these previous years when the interest rates were really low. But in scenarios in which the interest rates are increasing by the Federal Reserve, of course, this will have the result of higher unrealized losses that are not being included as part of these capital adequacy ratios. And of course, it is possible probably that this capital adequacy ratio should have been lower than 7.2% in the year 2022. Probably it could be, for example, lower than 4%. I don't know. In the following years, we don't know if there could be more and more interest rate hikes, and there could be, of course, more unrealized losses as the company is holding more long-term bonds in its balance sheet here. So this is another factor that truly encouraged me to use the price over book value as a way to measure the intrinsic value of this company. And of course, because we are incorporating in this way the quality of the balance sheet here. Now, if we just want to assess the intrinsic value of this company or the multiples here, for example, we can compare Charles Schwab with other financial institutions like, for example, Goldman Sachs, Morgan Stanley, and even Interactive Brokers here, which is not a bank at all. It is just a platform more similar to what is to the business model of Charles Schwab. But look at this. If we have, for example, the price to earnings ratio here, it is something like 16 in the case of Charles Schwab, but it is higher than Goldman Sachs and Morgan Stanley, but lower than Interactive Broker. Probably since this standpoint, you would say that, well, it is not so cheap, but it is not expensive as well. In the case of the price over sales, you can see here that the multiple is higher in the case of Charles Schwab. Price to book value is the multiple of Charles Schwab is the highest here. And of course, this could have been explained by the fact that that in the case of the revenues in the last 2 years, just looking into just calculated compound annual growth rate, the company has shown a better or a higher revenue growth here than its competitors here, than its comparables. And in the net income, as I told you before, the net margins of this company has been pretty well higher than any other financial institution here. So really, probably these kind of high multiples are really well justified since this standpoint here. I think that we need to look at the valuation of this company by itself. Okay, look at this. If we take, for example, here the price to earnings ratio here for in the last 5 years, I'm taking this information from Ticker Terminal here, and if we take, for example, here the last 5 years, you can see here that the mean of the price to earnings ratio is 22.8 times earnings, and the last price has been 7 times earnings per share here. Okay, so really you can see here that most people would consider this as an attractive price to get into this stock really. But you should remember that with the price to earnings ratio, we are not taking into consideration the quality of the balance sheet, which is crucial in a financial institution. Here, the only thing that we are considering here is the growth, the revenue growth in the last years, which has been double-digit growth here, as I've shown to you in the metrics of this company. But of course, it doesn't matter if the growth of these revenues are really good, if the balance sheet really could exhibit a lower quality here in the following years, particularly if we are, for example, long-term investors, really. Okay, so for me, I wouldn't take this ratio, this multiple, as something really important for this company. Instead, I would use, for example, the price over book value here, the price over book value per share here, and look at this, how things are completely different here. Look at this. In the case, for example, in the mean of the last 5 years is 3 times book value here, whereas in the case of the last price is 3.8 times book value here. So that means basically that according to this measure, the stock is not cheap at all. Really, it's expensive, and you need to remember. You shouldn't forget that in this video you have seen how much exposure this company has respect to the long-term bonds, which are mostly affected by the interest rate hikes because they are more sensible to the interest rate hikes as well. I would stick to this methodology, to this multiple here, because we are incorporating the quality of the balance sheet here. Because if we, for example, if we expect that the book value of this company, I mean, the assets of this company in value will decrease in this year and will decrease in the following years just because of this great exposure to longer term bonds, it means basically that the book value will be reduced as well. But I would wait for a further decline of this stock. Probably in order for me to be encouraged to buy this stock, I would wait for a lower than 3 times book value here for me in order to consider this stock as a really attractive and taking into consideration the quality of the balance sheet here. So in this video, I'm sure that you have learned an important factor that most investors are not taking into account just because they haven't explored more a financial institution like in the case of Charles Schwab. But of course, if we are long-term holders, we need to take care of the kind of the price that we are paying because we need to select the best price. And I think that this reference, this benchmark of the price over book value per share for us, I mean, this is my particular view, is the best one to reflect the quality of the balance sheet of a financial institution like Charles Schwab, really. So as you have seen, really, Charles Schwab has demonstrated to be a rock-solid business model because, well, it has certain assets. I mean, the company has plenty of liquidity to face, for example, potential bank runs. The company has a truly well-diversified deposits. I mean, it is not focused in just one sector or just a few companies, like in the case, for example, of the Silicon Valley Bank. The company really is well-diversified, has a well-diversified uh, deposit through millions of different brokerage accounts here. So really the company has demonstrated as well to have really a plenty of liquidity to face any sort of situation here in which, well, there could be the possibility that I don't know, that there could be more interest rate hikes, and of course that could trigger the claims of the deposits of the different depositors, and really the company has plenty of cash to satisfy those claims, and into the fact that really we are talking about a really an asset light company, as I have demonstrated to you in this video. So it means basically that the company has a really significant net margins higher than many other regular banks, and that of course give the company the possibility to raise interest rates in its deposits in order to slow down the decline of the deposits here. And I'm sure that this will not affect its net margins because the CEO, the management, is planning to launch more new products in its platforms. So it means that really the company could compensate the higher cost if in the case in which the company decided to raise the interest rates for its deposits. So this is the good thing to have a company with a higher net margins here, because the company has plenty of a great room to rise a little bit its cost through the increase of interest rates in deposits here. So, and of course, something really important that we have learned in this video is that we need to be really cautious in the calculation of the intrinsic value, particularly in the case of financial institutions, and particularly in this case in which we are facing this kind of interest rate hikes by the Federal Reserve, because, well, it has been well established by the Federal Reserve that it wants to reach the 2% inflation rate target. So it means that there should be more interest rate hikes. And of course, we need to use a methodology to calculate that intrinsic value of the company that incorporates this factor of the quality of the balance sheet here, because we know that there is a great exposure of Charles Schwab to the long-term bonds, because the company is holding a great portion, a significant portion in long-term bonds here. So really, with the calculation of the intrinsic value using the price over book value per share, we has established that the company is not cheap at all. It's expensive. So I would, since that standpoint, I would expect, of course, I would wait for a further decline of the stock to consider attractive and buy the stock of this company here. I hope that you really have enjoyed this video. Please put a like if you consider this is a video that is adding value to your investment knowledge. Consider to subscribe if you think that this channel could add value to your investment knowledge. Share this kind of videos to a colleague, to a friend, because I think that this kind of videos could be really helpful for them. So really, I will continuously delivering more and more information about different concepts, about different stocks, always since the value investing philosophy point of view. So I hope to see you in the next video. Peace.